Let's make money. I'm Joe. Let's make money by understanding what call and put options are. Okay, so options, in some other videos I've advocating being the seller of put options, not the buyer of put options. And that's going to be something that I'm going to want to drive home a lot. Most options expire worthless. So as we're talking about these options, keep that in mind. So an option is the right to buy or sell a stock within a certain time frame. A call option and a put option. So a call option is the right to buy a stock at a certain price before a certain time, and a put option is the right to sell a stock at a certain price before a certain time. So if you think that, let's use Arch Coal. If Arch Coal, you think Arch Coal is going to the moon before, let's say, the end of the year, you think that, that Mitt Romney is going to win in November, Arch Coal is going to go to the moon, you might buy a call that expires after the election. Let's say you buy a call that, I think there's one that expires November 17th. You might buy a call that expires November 17th. And so if he gets elected, and let's say Arch Coal goes to $20, and you bought a call at $10 with a $10 strike, I'll use a different number to make it a better example. You'd say you bought a call with an $8 strike, then you make that $12 difference. You have the right to buy Arch Coal at $8. You could sell it right at that time for $20. There's your $12 difference. That's why people buy options. If you took the money that you spent on the option and spent it on common stock, you could not buy nearly as much stock and your profit would be much smaller. However, that $8 option, that $8 call option is an out of the money option. So right now, Arch Coal is trading in the $6, $7 range. If you bought a call option to buy it at $8, that's out of the money. If it expired today, it would expire worthless. Arch Coal needs to go up a lot. So that call is probably pretty cheap, because it's going to expire at a certain time, and right now it's worthless. So you could buy a lot of those calls. So that's what people do. It's a big gamble, very risky. And you can make, if you're right, you can make a lot of money. Most of those options expire worthless. That's why a lot of times it's better to be the writer, the seller of the options. And most individual investors never even consider being the seller of options, being the writer of options. Okay, a call option is the right to buy a stock. Options also refer to 100 shares of stock. It's a little confusing. When you see a call option or a put option, the price that it's selling at, it'll say like 54 cents. That's if options worked one share at a time. It's always lots of 100 shares. So why don't they list it at $54 instead of 54 cents? I don't know. They should. So that option would actually cost you $54, and you'd have the right to buy or sell 100 shares, not one share. Okay, so a call option is the right to buy 100 shares of stock at a certain price before a certain time. That price is called the strike. The expiration date is when that is the name of the date that when it expires. Okay, and then a put option is the right to sell a stock. If you're bullish, you buy a call option maybe. If you're bearish, you think a stock is going to go down and you want to make money on that, you can buy a put option. So if you buy the right to sell Arch Coal at $5, let's say, and it gets trashed and goes to $2, you make that difference, that $3 difference. And because, let's say, again, Arch Coal is trading in the $6 or $7 range right now, that $5 put, if it expired right now, it would be worthless. Who would want to sell Arch Coal at $5 when they can sell it right now in the $6 or $7 range? So it needs to get slammed. Arch Coal needs to get slammed for that to make money. So again, that's an out of the money option, out of the money put option. It's probably pretty cheap, because it's going to expire, and if Arch Coal doesn't move a lot the way someone wants it to move, it's going to expire worthless. And so they can probably buy a lot of them. If it's a big move, you can make a lot of money. So you hear somebody made a lot of money in options, maybe they bought a lot of out of the money options and bet right. Most options expire worthless. So if you're the buyer of options, you're on the clock immediately. When you buy an option, it always has an expiration date. So it's like when you buy a new car, it starts losing value right away. So why not be the seller of cars? Why not be the seller of options? So when we're advocating selling a put, the person you sold that put to, they want the right to sell that stock. They're bearish on the stock, you're bullish. they're losing what they bought from you is losing value from the time they buy it until it expires. And so if that stock, if the underlying stock like Arch Coal stays where it is, you're virtually making money the entire time until that option expires, and you in real life make money. And then so that's selling a put. So we talked about buying a call, buying a put. That was selling a put. You can also sell a call. Now that's very dangerous. Selling a put is very conservative. If you bought a common stock and it went down, or if you sold a put and that stock went down, you're actually better off having sold the put, because you take this exact same amount of pain as if you owned the common stock, but you also got paid a premium to be in that position. So it's a very conservative strategy. If nothing happens, you get paid and made money. If something bad happens to your stock, you get your losses buffered. If your stock goes up, you can make a little bit of money until you hit your strike price, and that's your trade-off. You lost the upside in order to get those other advantages. Okay, selling a call, now you're giving someone else the right to make a big payday if that stock goes to the moon. So if you sell a call on Arch Coal, let's say at $8, let's say, and it goes to 20, somebody is going to say, okay, I want to buy all the Arch Coal from you for $8, and maybe you don't have any Arch Coal, so you got to go out on the market, buy it for $20, and sell it to them at $8. Not good. So selling calls is risky. It's a way to take a bearish position. It's sort of like shorting. It's very, very, very much like shorting. So when we advocate selling a put, very conservative strategy. Some stocks don't move that much. And if the options on them are not very expensive, because people don't expect there to be a big move. So if you go to sell a put on a very secure, conservative utility, let's say, nobody's going to pay you a lot of money for the insurance on a utility. But if you sell insurance on Arch Coal, somebody's going to pay you for that, because coal is so scary to a lot of people. And so selling a put in a big weight that you can get income. Instead of sitting back and waiting for dividends, selling puts is a lot of people will say a much better way. And by the way, if you sell a put on a stock that pays dividends, check it out. It's always priced into the options. You always get paid more than that dividend. If you were to sell the put, not have the common stock, and then not get paid the dividend, you're always better off with selling the put. That what you get paid is always more than the dividend. And then another way, a thing that's analogous to selling a put is selling a call if you own the common stock. So writing a put and selling a covered call are the same things. So didn't you just say, Joe, that selling a call is very, very risky? Yes, it is. But if you bought the stock, if you bought Arch Coal and then sold someone the right to buy it from you at $8, now you don't have to go out on the open market and buy it for $20. You already own it. So it's a covered call. So a covered call and selling a cash secured put are two very, very equivalent things. Someone did a study. It turns out selling cash secured puts has, in this historical study they did, has a ever so slightly small advantage. So I like to say, hey, sell cash secured puts. It also tends to give you one less transaction. So maybe you pay one less transaction fee over buying the stock and then selling a covered call. Hey, I hope that was helpful. I'm Joe. We'll make more money later. See ya.